Hi again everyone, this is Peter from the Mindful Share Trader blog and welcome to video number 6 in my chart reading series. And today I'm going to be showing you how to identify weakness in a stock or a market. And I'll be splitting this up into a couple of videos. The reason being that there's a lot to cover on this subject and I'd really like to keep the video short and to the point and just deal with a couple of subjects on each one. So in this video I'll be looking at upthrusts and signs of no demand. So I'm going to start off by looking at the chart, the monthly chart of gold that we've got here. The reason I'm looking at the monthly chart is that I like to look at the larger picture first, then pan into the weekly and then into the daily to get a better view of it all. And we can clearly see on this chart that gold's been in a long uptrend from about 2000 and since the late 2011 highs has since then been in a downtrend. So let's look at this chart and we'll see what signs of weakness there were that may have been up here and served as a warning that the trend was going to turn. And the very first thing when we look at this is we see this very, very high volume here. Now, if you remember from the previous videos, I talked about how important high volume is on the chart, in that it represents the activity of the market professionals, or the smart money as I like to call them. So on the monthly chart here, that really high volume was a warning that something was changing. And when prices are up this high, it has to be viewed as potential supply coming in. Now, if we zoom in, we can also see that on this high volume here, we have a widespread bar. It's on the high volume. It takes out the previous high, and it closes down in the lower half of the bar. And this is an upthrust bar. Ideally, if there's very high volume on the previous bar here as well, which there is, that also adds to the overall picture of weakness. Upthrusts are the result of buyers keen to get in and the professionals selling into their buying. Often the price is deliberately marked up, usually on the open, and this serves two purposes. It takes out all the short stops sitting up above the previous bar, and it also creates the impression that the up move is continuing and sucks in new excited buyers who can then be sold to. It's very common to see this kind of setup, especially after good news that's being expected is released to the market. And a good example of that recently was Apple. Now, I must make it clear here that an upthrust in an uptrend is not a bearish signal. It will usually cause a pullback or some sideways ranging, but that's about all. And you can quite clearly see that here. We've got one here with a bit of a pullback, one here, and one here. So we never short a stock in an uptrend on that one signal alone. It's bearish at market tops like this, but only when it's confirmed, and it's a great place to go short in a downtrend if you see them in a downtrend. So we have this clear sign of weakness on the monthly, and so now we're going to pan in a time frame and we'll take a look at the weekly chart. Okay, so here we have the weekly chart, and of course the first thing that catches our attention is the extremely high volume on bar A. Notice it takes out the high of the previous bar. It's widespread, but look very closely at the close. It's very poor, and it's in the lower part of the bar. And this is an upthrust bar. It's a sign of weakness, and it alerts us to potential selling coming in. Now the next bar on the face of it looks positive, but notice it goes up on less volume. It's narrow spread, and it can't even take out or get close to the high of that previous bar. It does, however, close higher and look positive, but it's really the trap being set. And sure enough, on the next bar we have more weakness, and we've got another upthrust bar there. So what we now have on this chart is two very strong signs of weakness over 2 weeks. And if you're an aggressive trader, you might go short on either of those, but they are technically in an uptrend. And to be safe, you really would want confirmation. It'd be safer to wait for the price to roll over, come back up, make a lower high, and test this area of supply, which is what we see here on bar B. And bar B is a no demand bar, and once confirmed is a great place to go short. Okay, so what is a no demand bar here, you ask? Okay, I'll explain. A no demand bar is an up bar with a narrow spread, usually closing in the middle or lower, and the volume is less than the volume of the previous 2 bars. I'll repeat that. A no demand bar is an up bar with a narrow spread, usually closing in the middle or lower, and the volume is less than the volume of the previous 2 bars. This particular bar closes higher, and that does happen, and therefore needs confirmation. And the no demand bar is confirmed by the next bar closing below the low of the no demand bar. And when you see this kind of setup, it represents no demand for higher prices from the market professionals. And of course, without them and their deep pockets, prices just continue to move down. And on this chart, we can see this after the prices dropped from bar A. Becomes oversold pretty quickly. Some demand comes in here. We then get a rally up. But as we can see, the rally's going up on decreasing volume and shortening price spreads. We then get a no demand bar on bar B, which is then confirmed the next day, and then the stock continues its downward journey. So let's finally look at the daily chart, and we'll see what signs of weakness we have on that. Now on this daily chart, we can clearly see the swells of volume, which indicate where weakness was appearing, and I've circled them in yellow. Remember that the professionals don't just sell at the top, they sell on the way up to it as well, so that they'll have plenty of buyers that they can easily distribute to. They'll also hold the price up there while they're doing this, which is why we see a lot of volatility at market tops. Make sure you watch my video on accumulation and distribution, and you'll get a better understanding of that. We can also clearly see the upthrust bars. I've highlighted them with the red arrows, and the no demand bars are the ones in green here. A fair few signs of weakness there when you look at it like this. There are actually 3 warnings there to get out of gold, but of course greed and hope keeps most people hanging in there until it's too late. Interestingly, we have a no demand bar right here followed by an upthrust. Now if that wasn't a signal to go short, so I don't know what was. So there we have it, a basic introduction to upthrust and no demand so that you can start identifying weakness when it appears. Get your charting software out, have a look at some charts, see if you can identify the signs of weakness I've just shown you. And I think you'll be quite surprised by how many upthrusts and no demand bars you'll find prior to drops in price. I'll also be putting some more detailed posts about this up at mindfulsharetrader.com over the next few months, so make sure you subscribe there on the site and you'll get notification when I put them up. If you can learn to identify weakness on the chart in advance of a drop, it can save you a lot of grief, and it gives you an early warning to get out. So it's worth taking the time to understand it. Well, that's it for this video. Now, most importantly, don't forget to subscribe to my YouTube channel by clicking on the yellow button here, and you'll be notified as more videos go up. Subscribe to my newsletter at mindfulsharetrader.com, and you'll receive updates on all my content, as well as extra content that's not on the blog, and you'll also receive my free resource guide, which shows you where you can find free charting software and data and helps you get up and running and learning to read a chart. Okay, so thanks for watching, and till next time, bye for now.